Blackstone reporting in the last hour earnings of $1.21 a share came in 11 cents better than estimates. Revenue of $3.1 billion also topping expectations. Total assets under management growing 13% over the prior year to $1.2 trillion. That is with a T. And joining us right now to discuss all of this, Blackstone President and COO Jon Gray. Good morning to you. You beat all the way across the board, and the assets just keep going up and up and up and up and up. I think the big question, we can go around the world as we keep describing in some of the teases, John, but let's go back in time just for this quarter, and then let's try to project out, because I think we all want to understand what you think is going to happen next, given that we're now maybe finally going to get some clarity on tariffs and everything else.
Well, Andrew, it's great to be with you. We did have a tremendous quarter. We delivered for our investors. That's the most important thing. We had the most fund appreciation in nearly 4 years. We delivered for our shareholders, the earnings growth, which was up sharply. We also raised another $52 billion of inflows. But the real key is looking forward, to your point. We've got a strong cyclical updraft that's coming because we feel like the deal environment is really starting to take hold. That pause after Liberation Day seems to be passing as equity markets recover, debt markets recover, and M&A and IPO activities picking up. And then we have these secular trends, private wealth, private credit, infrastructure, and the combination of that cyclical growth and the secular long-term tailwinds makes us feel very optimistic looking forward.
When you look at your portfolio companies and you look at just the earnings that they have currently, you also look at some of the tariff issues that they may confront, putting aside assets under management and everything else, just on the actual operating businesses themselves, what do you see for the next 12 months?
Well, we've seen very good resilience. Obviously, companies in the sort of teeth of the storm in manufacturing and retailing are dealing with some issues. That's a small piece of our overall portfolio. In the second quarter, our companies in private equity had high single-digit revenue growth, and they saw margin expansion. And so that makes you feel pretty good. And as we look forward, the fact that these tariffs should be getting resolved, we've seen some progress on that. There's sort of a sense of the contour of what these deals will look like. We still have pretty good underlying growth. We could very well get some easing from the Fed. For us, it feels like a good environment. There's always risk out there, but it feels strong. And when we talk to our CEOs, they're feeling pretty good about their businesses. When you look on the credit side, default rates for us amongst our non-investment grade borrowers, just 50 basis points. So it's a pretty good picture. Housing is still a little weaker. We have a little bit of consumer weakness. But overall, I would say the sentiment and the outlook feels good. And I think the most important thing is what's happening with AI, what's happening with energy and digital infrastructure. And that feels like it could really lead to a productivity boost and accelerating growth in the economy.
Let me ask you about the data center AI energy piece, because there's sort of an ecosystem there. And it's been a huge investment thesis for you, but a lot of others as well. Is there any concern you have that space is going to get crowded and that regulators are going to get involved in a way that they haven't thus far?
Well, there's always a risk when you have an investment boom that you get excesses. You could go back to the railroads after the Civil War. A lot of people lost money, even though railroads were important. You go back to the internet age. In this case, there is enormous demand for physical infrastructure. We obviously need these large language models. We need the NVIDIA chips, but we need this physical infrastructure. We need data centers. We need energy and power. And so the investment dollars are enormous. And if you look at the big tech companies, they're talking about spending more. Just yesterday, Google upped their CapEx budget. Big hyperscalers are talking about $350 billion to spend. So we continue to see a lot of demand here, and we're doing it in a prudent way. We only build these data centers when we have long-term leases. To your question on regulation, I think the issue will really be around energy and power, what happens to consumers. And I do think we're going to need to build new capabilities, new energy and power nuclear, natural gas, renewables, all of
Right.
the above, because we don't want consumers to suffer.
So and related to that, though, and Becky and I were talking about this, I think, just yesterday, you know, a lot of the big tech companies, the Googles of the world, Amazons and others, who are contracting for these data centers and contracting for the energy that therefore is attached to these data centers are saying, look, we need to have 99.99999% uptime. This has to be work. This has to work for us. And therefore, the energy has to be guaranteed to us. And so, therefore, there's this question, especially, well, some of the stuff's on grid, some of it's off grid. But the stuff that's on grid, there's a question mark about, you know, if there's a hurricane, if something happens in the world where there's not enough energy, who's going to get the energy? Since the companies, the tech companies, have effectively contracted to get that energy ahead of the consumer.
Well, I think there's a lot of focus with local utilities. We're big investors in the utility space, and there's definitely a priority towards consumers. That's why the digital infrastructure really needs new power capabilities built. New generation, new transmission. I was in Pennsylvania last week, and what's exciting there is they're talking about building new natural gas power plants directly adjacent to data centers for this very reason. So I agree with you. We need to build more. This is critically important, and we have to keep consumers in mind. We have to protect them.